Hello everybody. I want to tell you about a recent investing problem that I had and share what I did with you. But before I do that, none of this is financial advice. This is just an idea I had and put to work. So we're going to talk about it today. So the issue that I had is I ran out of money to invest. This was at the tariff tantrum that got thrown. The market dropped down and I ended up buying more of my favorite stocks. But the problem was I wanted to buy even more and I was just out of money. I still like all the stocks that I'm in, but I ran out of funds. So I started looking at margin investing, and I've done that before a little bit. And I use the Fidelity system to do my investing, and I really like the Fidelity system, but their margin rates are pretty high. I think their base rate is about 12%, and it does go down as you invest more, but I think the lowest you can get down is something like 8.5%, and that just doesn't work out very well for trying to invest in margin. So I have all my funds with Fidelity, but I just don't like their margin rate. So I was kind of looking around. What I found was Robinhood has really low margin rates in comparison. And so Fidelity started at a base rate of about 12%. Robinhood's was 5.75%. And that's just quite low. And then they had some different tiers as you kind of progress. And so if you, I think it was a $25,000 if you do that much. No, it was 50,000. Then the interest rate drops by about 0.02%. And if you get above $100,000, it's down by half a point. So basically, if you invest, if you have $100,000 of a margin loan, the interest rate is 5.25%, which is really, really low. So I thought I'd try margin investing out. Now, as a disclaimer, I don't really trust Robinhood. They had the whole GameStop fiasco that happened a couple years ago. I know their stock's doing really well right now, but you know, I think it's fine to invest with them, but personally, I'm not going to really trust them all that much. So the Robinhood accounts, basically any investment account, is insured up to $500,000 through investment insurance. So eventually I'm kind of thinking I'll port over maybe $250,000 to Robinhood, invest the other half, and then I'll know that I'm covered at $500,000. And that also does another thing, because I have more than $500,000 at Fidelity. So by moving some funds over, it'll kind of round out my insurance coverage. So that's kind of what I did. I decided to move some of my existing stocks out of a brokerage account that I have with Fidelity, put it over in Robinhood and give it a try. So I did. I moved over 100 grand of stocks. They seemed to go over pretty well. It took, I don't know, 5 business days or a couple business days or whatever. They were already positions that I had. They were things that I wasn't really planning on moving or selling out of. So moved them over to Robinhood, and then kind of slowly started buying some things. And the names that I was really interested in were low after the tariff tantrum. And I wanted to try a particular dividend investing strategy and kind of present this to you. And basically the things that I'm interested in have pretty high dividend yield. And so I'm kind of doing an arbitrage where I'm going to use my existing stocks to buy some more, some high dividend payers, and they pay out more than the interest rate. So the thought is that over time, the margin will basically buy the shares for me, which I think is kind of fun. Now, there's certainly risks to that, and I'll have to say I've seen several videos from people that talk about doing some of the, there's some new dividend ETFs that are really high. The covered call ETFs, But the problem is that they have the risk of NAV erosion. So you got to be careful if you do this dividend strategy to choose things you think are not going to erode the purchase price, but then allow the dividends to pay this off. So the stocks that I chose to do are some pipeline stocks. I mainly chose Western Midstream and Plains All American. Western has a dividend yield of about 9.5%, and Plains was about, at the time, I think it's near 8% now. It was 8.5 or close to 9 at the time that I was purchasing it. And so they pay out yearly higher than what my margin interest rate would be. So those are both master limited partnerships, which send you K1 statements. So just be aware that if you choose to follow what I did, you got to be aware of that. Plains also has a general partner. The ticker is PAGP, and it pays about the same as their limited partnership, which was PAA. I think it's just below 8% now for the dividend yield, so you can still play this if you're interested in. So basically, the stocks I chose, they were going to pay out 9.5% on average a year, and I kind of spread the investment out over a few of them. But if you just stick with PAGP, it's pretty close to that. It's about 8%. So in my case, because I got the margin interest rate above 100,000, my interest is 5.25%, and on average, these stocks are going to pay out about 9 to 9.5%. So, like, let's say it's just 9.25 versus 5.25. So on a $100,000 investment every year, it'll pay out $9,200 or $9,200, and then the margin expense over that same time frame is going to be $5,250. So over the year, it'll net out that a 4% difference, so roughly about $4,000 just in the dividends. Now, I really like these pipeline stocks. I think they'll appreciate, but even if they don't, using this margin strategy where you borrow $100,000 against 100 grand of your existing stock, over the course of a year, you net $4,000 of a profit. Hopefully they still continue to appreciate, and over the years, stocks tend to try to increase their dividends as well. So put together a spreadsheet just to kind of analyze what was going to happen here. And basically, if I was just trying to pay down the margin loan with the dividends, it would take, I don't know, somewhere between 14 years, I estimated, with a little bit of a dividend increase each year, maybe a little bit of a price appreciation, if I was just paying down the margin loan. But you can also buy more shares. So instead of paying down the margin loan, I'm going to keep that margin loan at 100 grand year after year, and then every year I'm going to buy more stock with it. And in the spreadsheet, when I kind of projected forward year after year with a little bit of a dividend increase, a little bit of price appreciation, looked to me like in about 10 years time, it would make back 100% of this investment. So eventually the margin will pay for this $100,000 worth of shares that I purchased. And so that's basically using other people's money in order to gain a profit. And I did a projection on basically however much you borrowed over that same 10 years, if you're invested in these higher paying dividend players, you would get that same amount back. So whether I bought $100,000 worth of stock, or I bought $250,000 worth of stock, or I bought $1 million worth of stock, the numbers kind of work the same way. As over that 10-year period, you're going to get all of your principal paid back. So it's kind of interesting. You guys can play around with it if you have an interest, but just sort of interesting. Now, kind of thinking of risks to this whole procedure. At any time, Robinhood could increase the interest rate. So if they did that, that would kind of throw off the principles or the numbers here. But at that point, hopefully, if it didn't work in my favor, I could always just buy the shares out, close out the margin account, move my stuff back to Fidelity, and that would be fine. The share price could also go down over time, so that's certainly a risk. But every year I think you end up buying back 4% more shares. So if I'm not living on the dividend, if I'm just reinvesting shares, slowly over time my basis will go down for the shares that I buy. And so I think that lowers the risk of individual company reduction, because I'm going to be buying more shares with the difference between my margin interest rate and the dividend interest rate. So that's something that works out in my favor. We'll see what happens with that. It's kind of an experiment to me. I'm not risking much of my portfolio here. I've just peeled off a portion of it to try this experiment, but I'm really curious to see what happens. And as I look back, if I had done this strategy over the last few years, all the pipeline stocks that I owned, they've all appreciated quite a bit over the past couple of years. They're up 20%, 30%, 40%, 50%. They've grown really well. That's just in the price. Plus, they've also thrown off really good dividends, like 7.5% on average, or maybe even more. So it's been kind of the best of both worlds. In the pipelines, you get the both price appreciation and dividend yield. And so hopefully it continues. It's hard to build new pipelines. So I would imagine that these shares hopefully stay above the price of inflation, or stay ahead of that. Plus they raise their dividends every year, and that by buying more of these shares, then I increase the eventual payout. And my goal is to be able to live off dividends, that I really don't have to sell shares, but that they will provide the income that I need to reach financial independence. I'm really close to that. I think I could end my work right now if I wanted to, but I'm just kind of being cautious and making some plans. So I thought I'd share this idea with you today. Again, I really like Fidelity. I don't know if I trust Robinhood all that much, but I wanted to try this experiment. I did verify that as I crossed over the different margin borrowing rates within a couple days, Robinhood did adjust my interest rate so that it reflected what they said it would. Kind of started at 5.75%, then it went to just over 5.5%, and right now I'm at 5.25%. So every year I'll end up paying $5,250 in interest, and the stocks that I own will pay about $9,250. So again, by doing this strategy, it should put another $4,000 into my pocket each year. And just kind of interesting way to use margin. Be careful with it. It's a way to juice your returns, but you can also lose a lot of money more quickly if you do that. So I guess I'd mention Robinhood. Once you purchase, like if you put my $100,000 that I put into the account, gave me another $100,000 of borrowing ability. So I put 100,000 in, borrowed 100 grand, so I have $200,000 worth of stock there with them. And if the amount goes down, you have about I think it said 58% margin buffer. So even if I think the way that works out is if the value of my shares fell by half, I would still be somewhat safe. I might have to add a few more funds to that. And my plan for that is, if that does happen, I will just transfer in some more shares from my Fidelity account to boost up that margin buffer. So even though I got $100,000 worth of margin buffer, but I only need to keep roughly a quarter of that in the accounts. Otherwise, you can get a margin call, and they sell some of your shares. So just be careful about that. So you get a margin buffer. You could get margin called if the shares lose their value. But I'm really curious about this overall arbitrage, where I can get a 9.5% dividend yield from the pipeline stocks that I chose. I'm only paying 5.5%, or just under 5.25%, and we'll see how that happens over the years. And according to the calculations, it should purchase the 100% of what I put into it originally within about a 10-year time frame with any luck. So So there's a potential idea. You could try that if you want to. You could, if you have a Fidelity account, you can pay the really high margin rates, but I don't recommend it. Those are just much higher. But who knows how long Robinhood will offer that lower interest rate. I know they're trying to grow like gangbusters, and it's certainly a reason to try going with them for the sake of that low margin rate. So I'm sure they're using some of that to buy their customers. So best of luck to you. Hopefully this idea helps. Give me a like if you find this interesting, and leave a comment if there's any gotchas or things you might have tried, and we'll appreciate you. See you, bye.